Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you, hit thumbs up and subscribe. Questions, comments, put those below. Lots to talk about this week. Obviously, we know what is happening around the world. The macro doomsday headlines are making their way across the internet. So I'm going to try to avoid some of that, but certainly we can't not discuss what is happening. Clearly, there is so much happening with political tensions, trade wars, deteriorating economic data continues to come in, particularly in Europe and Asia, where this is gravitating more and more towards clearly a global downturn. And there's much to see how this plays out, but some very, very interesting things shaping up. You can see the reactions from the world's central banks, all of them cutting interest rates in basically what I'm calling, and some of others have called, it's the race to zero. Every single central bank is racing to devalue their currency and to try to support the economic expansion and try to avoid their economies from tipping into a recession. So definitely a very precarious times. But it just goes to show that the central banks, are doing whatever it takes, despite so-called repercussions for that. So everybody is well known. The BIS has talked about it. The IMF has talked about it. There's basically three countries that they continue to talk about ad nauseum. It is Australia's housing and debt bubble, New Zealand, and of course Canada are usually the big three. All we have to do is look at Australia, which has had a lot of problems of their own recently. The Australian Central Bank has now cut interest rates twice already this year, and queuing it up is New Zealand Central Bank. Of course, New Zealand brought in a foreign buyers ban. They banned foreign buyers last year. Markets started to soften a little bit. Their central bank stunned. Those are the very words of market commentators. They stunned markets with a 50 basis point cut just about a week or two ago. And so, interestingly enough, despite these countries having these housing bubbles and record levels of debt, they're aggressively slashing interest rates closer and closer to zero before they hit that zero bound. And of course, if this is actually going to provide any stimulus, we shall see. I think that you're pushing on the string, but it's funny as you turn into Canada. I'm reading these headlines that Bloomberg surveyed Canadian economists, and the Canadian economists are in consensus majority that the Bank of Canada is going to somehow remain on hold in terms of cutting interest rates until the end of 2020, which I can assure you, well, at least in my opinion, there is a 0% chance of that happening. The 90% of the Canadian yield curve is now inverted. This chart, courtesy of Crescat Capital. I've been following along with a lot of their work recently. Some of their positioning and whatnot I find very, very interesting. They are focused on the Canadian space as well as what's happening in China. And so looking at that, you have 90% of the yield curve is inverted in Canada. All these yields going out to the 30 here are now below the Bank of Canada's overnight interest rate of 1.75%. So there's absolutely no chance the Bank of Canada won't be cutting, particularly as the Fed is going to come with at least another 25 basis point cut in September, maybe even more. And so, oddly enough, let's recap this. What is happening today? So you basically have all these yield curves inverting, which is a strong indicator of a future recession. Central banks aggressively cutting interest rates closer and closer to zero bound. Basically very little room for them to actually cut rates. They're actually going to be cutting rates into negative territory, trying to stimulate the economy to keep it from entering into a recession. And despite this, what is the reaction? The reaction of the markets, at least from housing, is there's a pickup, not just in Canada, but if you actually look at some of the Aussie and US housing data, there has been a very slight uptick in sales activity and in some cases in prices as well. And so it's funny to me because I talked about this last week, and people say, I can't watch this channel anymore. You've turned, you've changed, your message changed. At the end of the day, the message is what's happening in the market, not to create some message that is going to confirm and form or pat your biases on the back. The purpose of this channel is to let you know what is happening in financial markets, particularly as it pertains to Vancouver and Canadian real estate, which is where I do obviously my work and my focus. So what we can see here is if you look at the Canadian real estate market, again, as I've talked about, there's clearly the markets, at least in Canadian housing, are reacting to the significant drop-off in mortgage rates, and that is allowing some increased activity in pockets of the real estate markets. Obviously, there is still weakness in general in the market. Obviously, there are still huge structural problems or concerns. I mean, one of those concerns is 90% of the yield curve is inverted, and there's a good chance we enter into a recession at some point in the future. So, of course, that is a significant headwind. But as it stands today, this is what's happening in the market. You have national home sales for the 5th consecutive month in Canada increased. So you had 5 consecutive increases now in housing sales. The prices now, if you look at Capital Economics, which is, again, an objective research firm. They're an objective research company. I found that they have tended to be quite bearish, actually, on Canadian real estate, the Canadian debt problem. A lot of what I discuss in these videos, I feel they echo very much a lot of the same things. And it's funny because they posted on Twitter just earlier this week, showing some of the Canadian housing data, that if you look at where the sales to new listings ratio is going, this suggests that prices should rise. Now, again, that's not to say that that is imminent or it's going to happen, but certainly this is a chart, and this is from Capital Economics, again, where they have a subscription to provide objective economic data and advisory services. They just don't work for a large bank. They don't have any sort of biases there. So I'm looking at them as a company that historically is quite bearish, is putting this chart up. And as we can see here in the Canadian National Home Price Index, prices actually increased on a year-over-year basis by 0.2%. Again, just sort of teetering. We dipped into negative territory. We've clicked back up by 0.2%. But we're still in this very concerning pattern or range where prices could easily drop further, or they could potentially rise. Again, my understanding of the market is that basically we are today in this very precarious economic situation globally. Canada's data certainly looks better than most countries, but obviously we are a very small fraction of the global markets, and as those economies roll over, that sickness will come to Canada regardless of what Stephen Poloz does at the Bank of Canada. So that's what I'm looking for. So what I'm saying is I see right now, clearly, this is not like my thoughts or opinions. All you have to do is look at the data. Clearly there is an uptick in housing activity. Is this sustainable? Obviously not if you get a recession, but that recession is not here today. So today, the lower mortgage rates, again, are helping the housing market. Today, I have clients now getting, these mortgage rates continue to come down. I have clients getting 5-year fixed mortgage rates at 2.69%. That's now down 100 basis points from the peak towards the end of 2018, when everybody was under the assumption that rates were going to go skyrocketing and that central banks were going to continue to hike interest rates. And of course, we've seen a complete 180 where every central bank now is again aggressively cutting interest rates as they try to keep this cycle from rolling over and dying. But that's where we stand today. So again, there's no sort of biases here, unfortunately. I'm looking at this. Again, it really comes down to how long is your outlook? What's your outlook? If you're looking for the next, if you're trying to make a decision in the next 3 to 6 months of should I buy today or should I buy in 4 months, I'm telling you right now, there's an uptick in activity from these lower rates stimulating. Again, if there's a recession, which the bond yields are suggesting is coming, then of course that is bearish for housing and real estate. I mean, people lose jobs, that impacts lending, etc. That shouldn't be a secret to anybody. But again, that's simply what the markets are telling us. How these things pan out and shape out remain to be seen, and that's why we do these videos every week, once a week. So hope that helped. Otherwise, see you next week.